Okay. Um, so we are starting cash flow. We talked about how working capital is the lifeblood of a business and whatnot. Now, um, it's the same thing. Cash is as equally as important. So your working capital is usually, is usually available in cash, right? So we could say that cash and aka working capital is the lifeblood of the business because you need money in hand in order to be able to uh you know pay off your short-term debts, pay off your bills and so. So it is the most, we know that cash is, it's in hand, and that's why you can make an instant purchase from it like right away. So it is the most liquid form of current asset. um your cash, it performs an important, it plays an important role, like I said, operating expenses, bills, salaries, blah blah blah. Now a new business may have to pay cash on purchase for all its supplies. Why? This is a special case. New business, a startup business, payment to suppliers always has to be, most likely it's going to be cash. Why? And they are unlikely to get a credit period. Now, why is that? That is because these businesses are, they're new businesses. Suppliers are just going to be like, maybe they won't make profit, maybe they'll make a loss, maybe they won't be able to pay the money back, and that's why they always prefer cash payments, because there are doubts to their profitability. Make sense? Yeah. It's a logical reason for them to
Okay.
do that.
Yeah.
Now, the difference between profit and cash, they are both, of course, uh, it's part of the cash flow and everything, but your profit is calculated at a specific point of time after you have paid off your bills, salaries, cost of production, tax, everything is paid, and then the money you get in the end is your retained profit. Your profit is, like I've told you before, is the difference between your costs minus your and your revenue, and then you get your um profit in return. Let's jump straight to cash flows features: cash inflow and cash outflow. Now, okay, cash inflows is the money coming in the business, and this is money going out of the business. In what forms can the money come into the business? In form of sales revenue, in the form of selling assets. It could be through, you could say, investors, bank loans or something, or any investor making, giving you some money to loan. And outflows could be your wages, salaries, your suppliers, payment to suppliers, maybe your loan repayments or interest. Could be so many things. Either way, bills and whatnot, purchase of machinery. It could be anything, right? Any money that's going out of the business is your cash outflow. So, when you minus inflows with outflows, you get your net cash flow. Okay? You get your net cash flow in the end. Okay? So These are your four key terms. Now, how can we calculate our cash flow? Now, cash flows are usually made, so they make their cash flows in advance, which means they make it based on a prediction. That means we're talking about a cash flow forecast. A cash flow forecast, I've told you before, is a prediction of the future. Okay, is it making sense? Am I going too fast?
No, it's okay. It's okay. Go ahead.
Okay. So a cash flow forecast is a prediction of what your anticipated inflows are, what your outflows are likely to be for the next 6 to 12 months. Okay. A business, it's an important document for a business plan, especially if you're a new business. You will need to show your cash flow forecast in order to get yourself a financial bank loan and so and so, right? It has its own advantages, disadvantages. I'll go over them later. But let's see, how can we construct one? So construct a cash flow forecast. Your step one is cash inflow. So you put up this heading of cash inflows, your months come here. Then you put up a heading of cash inflows, and then you list down all the cash inflows you have. For example, the cash you get from sales, so cash from sales or sales revenue, same thing. Then your maybe you took a bank loan, so capital investment, it could be a bank loan or whatever. And once you've written that down, you write the next heading, which is your total cash inflow. So whatever your inflows are, you write them down and then you total them. So let's say uh this was 4,500. We made our inflows increased and we are 5,300. This is all in dollars. Yeah, and then we've got capital investment. Let's say you took a $6,000 loan in March, and that's it, not the next month. And then we're going to do a total. That would be for 10,500. Then we have, I should have written it here, 4,800 and 5,300. My step one is calculating all my inflows. So in this case, your business is expecting to receive an inflow in March of your sales, as well as April and May. And then your capital investment, you could say maybe it was your the investors, the business owners' own savings. They introduced that money, $6,000 in March, and then that's it, not for the next 3 months. And then we just calculate the total. Once we have that total, the next heading that comes in is your cash outflows. Then you list down all your outflows. Let's say we put a rent, inventory, wages, and your utility bills and stuff, bills and utilities and so and so. And then we put a total cash outflow. Okay. Okay, now let's put in the numbers. Rent could be 1,400. Wait, I should be using that. Okay, not very useful, but okay. 1400. Rent remains the same for all months, so 1400, 1400. And then you bought some inventory for 6,800, 600, 800. And then we have our salaries, 2,100, 20. Salaries are same. This tells us that our employees are permanent. We've got permanent employees. Salary remains the same for all. And then our bills would be, or bills or something could be for 460, 460, 460, blah, blah. Okay, just putting in some random numbers. Then comes my final total. That would be 10,760, 4,560, 4,780. The second step is done as well. The total cash outflow is collected. Okay. The next step is calculating. So this was step 1. This is step 2. Cash outflows. And then we have step 3. Now we calculate our net. I don't know why it's doing this today. Okay. We calculate our net cash flows. How do I calculate my net cash flow? First, we write our total cash inflow, then total cash outflow, and then we get the net cash flow. So my total cash inflow is right here for each month, and total cash outflow is right here for each month. So I'm gonna write that here. It's very messy, but this comes here 10. Let me write it in red. It'll stand out. 10. Net cash flow, this is a minus 260. This, in fact, you put it in brackets, you don't put a minus sign. And then if it's a negative, you're going to put it in brackets. Then we have a 240. We've gone positive. So we started off with negative, and now we have closed with positive. After you have calculated your net cash flow comes your final step, which is calculating your opening and closing balance. Your opening balance is the money that you started your business month with. And your closing balance is that how much money you have at the end of the month. Okay? So after your net cash flow, you write your opening balance and then your closing balance. Now, opening balance is always, now listen, this is the tricky part, okay? Not so tricky, but just have to understand this. Your opening balance will always be the previous month's closing balance. Why? Because whatever you're closing with, let's say at the end of March, will be the money you start with at the start of April. For instance, your dad gave you a pocket money of $1,000 in the month of Jan. You went shopping, you went out with friends, and you spent about $800. How much money are you left with?
200.
$200. You're left with $200 in the end. So at the start of the month of Feb, You started your month with $200 and then your dad gave you your fixed pocket money again. He said $1,000. How much money do you have now at the start of Feb?
Wait, explain that again. Sorry, say that again.
Okay. So you ended your month of Jan with
Yeah,
spare $200.
yeah.
So
So I
that
have
becomes
1,200 then.
your opening balance. So this was your closing balance for Jan, right? Because you ended the month with $200, right?
Okay, yeah, yeah.
So automatically you started the month of Feb with $200 in your pocket. That becomes your opening balance. And then your inflows are coming in afterwards where your dad is giving you $1,000 and blah blah blah. But the closing balance for the previous month automatically becomes the opening balance for the next month. Does that make sense?
So it's gonna be 1,200 then?
It would be 200. Once you have your inflow from your dad giving money, then you will have 1,200.
Okay.
But it's not, you started the month with Feb $200 because you had 200 to spare at the end of Jan. So that money is automatically shifted to your next month, right? You saved money. So you started money with that. Make sense?
Kinda, yeah.
So in this, we are saying that this business is a startup and they are going to start their business in March. Can they have any opening balance?
Uh,
Do they
no.
have, yeah, they won't because they won't have any savings from last month because they
Got
just
it.
started the business today, right? So in
Yes.
March, on the 1st of March, they're starting a new business. So they won't have an opening balance because it's a new business. So it would be zero, right?
Yes.
And their closing balance. Okay, so what happens is that, is the opening balance clear?
Pardon?
Are you clear with how the opening balance works?
Yeah, kinda. I just need to go over it.
Okay. Now, the formula to calculate closing balance. How do I calculate how much money am I ending the month with, which is my closing balance? At the end of the month, how much money do I have? That
200.
is, it can't be because you must have made money up here and there, right?
Yeah.
So the formula for closing balance is your opening balance. Wait, let me find an easier one. Okay, that's net cash flow plus opening balance. So whatever money you had, you made through your sales after your inflows, outflows was calculated, whatever money you made, which is your net cash flow, that plus your opening balance. So in the end, my closing balance is not a positive one. Why? Because I didn't really make money this month. In fact, I'm going negative this month. Because I'm a new business, it's fair to say that in my first month I won't make profit because I have a lot of investments, right? Makes sense, right?
Yeah.
So my closing balance would be a minus 260, right? Because minus 260 plus 0 is a minus 260 again, right?
Yes.
Now, what is my opening balance for the month of April?
Uh, it's 260 again, no?
Very good. Exactly. Excellent. That became my opening balance. So minus 260, not 260, a negative 260. Okay? A negative 260 is my opening balance for the next month. Now I need to calculate my closing balance. How did we calculate the closing balance? Net cash flow plus opening balance.
Yeah.
So 240 and a negative 260 leaves me with a minus number again, right? It would be minus $20, right? 240 minus 60. Is it making sense?
240. Yeah. 240 minus
This is
60
this
is.
this is where you're, although it's plus, but we have a negative number, so the algebra works here, right?
Yeah. So it's
So
180.
exactly. So it would be $20 negative, right?
Yeah.
Then what is my opening balance for May?
180.
Think again.
260.
What is my opening balance for
260,
the month of
sorry.
May?
260.
Think, look.
Opening balance for May. Oh, sorry, 520. Sorry, my bad.
That's my net cash flow. Why would it be 520?
Sorry, I thought you wrote it under. Okay. It would be 20.
Yes. A negative 20. Okay. Now we are going to fall in positive. 520 plus a minus 20 is a 500, not a negative, sorry. We've finally gone to positive $500. So for the month of May, my closing balance was $500. Does it make sense?
Yes.
Let me just give you another one. We'll just make a rough one, okay? So let's say for the month of April, hypothetically speaking, my net cash flow maybe was 700. What is my opening balance for the month of April?
Opening balance for the month of April is 500.
Very good. 500. What is my closing balance?
Closing balance would be
Formula is right here.
yeah. Uh, uh neck. Okay, 1 second. Uh, 1200.
Yes.
Okay.
Okay. So
Yeah.
do we get it?
Yeah.
Okay, let me give you an easy task to do. It's a very easy one. Do this real quick and send me a photo. Or don't have to draw the whole thing, just write your answers and take your time, calculate your answers, and then let me know. I'll write them on the screen.
Okay, I'm gonna finish this then. Should I finish this?
Yeah. Have we
Okay.
calculated?
No, I'm gonna calculate it right now. I'm
Okay.
scared.
Just open your calculator. We can do it together.
Okay, so the closing balance, I'm gonna start from the closing balance because it's the
Mm.
easiest, I think.
All the highlighted blue ones are the
Yeah.
ones you are required to calculate. Okay, so go
So,
step by step.
okay, can I do the closing balance first? Because that's easy. It's 5,500.
How did you get your closing balance?
Because isn't it the opening balance for the next month?
But how did you get it for March?
Because if April's opening balance is 5,500, then March's closing balance should be 5,500.
Okay. Okay,
No?
you reversed it, fine. But okay, fine.
No?
Okay. Yeah, yeah, makes sense.
Okay.
Okay, I mean, wait, we let me just write it down properly, neatly. Because of this, fine, fair enough. But always follow an order, okay? Calculate
Okay.
this first, then go here, then do this, then do this.
Okay.
Why? Because I don't want you to miss out on anything. Okay, so
What
calculate your
had
total
okay.
cash outflows first.
I forgot what's the formula again?
Total cash outflows.
Um, one second.
Okay, look at this again. These are your inflows heading, and these are the
Oh,
inflows
sorry.
that
Yeah.
you have.
So inflows plus
Outflows
out.
are right here, and these are all your outflows. You just have to add them all up.
Got it. Got it. Okay. Gosh. But I have a question.
Mm-hmm.
Okay, never mind. Yeah, no, I don't have a question.
Okay.
So it's gonna be 90,500.
What did you add?
46,000 plus
Why did you add?
13,000.
Why did you add 46,000? Are
Because
sales
it's
your outflow?
okay, no, never mind. Sorry, let me do that again. It's gonna be 44,500.
Yes, 44,500. And I'm really glad you use logic, sure. Okay, but if you didn't know and this number was also missing and you didn't know, how would you have calculated your closing balance if this wasn't there?
I would have done the net cash flow plus opening balance.
Very good, good girl. Okay, then we have the next calculation, this one.
It's gonna be the wages is gonna be 31,000.
Very good. 31,000. And net cash flow?
Yeah, just give me a second.
Sure.
Is it gonna be 16,000?
Okay, how did you get that?
Actually, just give me a second. I want to do this again. I want to make sure I'm doing this again. Yeah, it's 16,000. I did 30,500 minus 14,500 because if you want to get the closing balance, you do net cash flow minus opening balance. So I did no, you do net cash flow plus opening balance, and that is 30,000. So if 30,500. So if I want to do the net cash flow, then I just have to do 30,500 minus 14,500. No,
So you got a 13. What did you get?
I got 16,000.
Okay, look here and see how we calculate. What was the formula to calculate your net cash flow?
Sorry, can you repeat that?
Okay, look at the screen and see what is the formula to get the net cash flow. You have to follow
Inflows,
the formula, otherwise you'll get the wrong
inflows
answer.
minus outflows. Okay.
Yes. Okay. So now do this, inflows minus outflows.
Okay. 1 second. Wait, one question. No, wait. So it'd be 13,000, no?
Yes. Okay. This
Yeah.
minus this is that. Okay. Now what I want you to do is, for your clarity, I want you to make a list. In your notebook, write the heading formula sheet
Okay.
for cash flow. Then I want you to write the formula for total inflows, total outflows, net cash flow, uh, oops, opening balance, and closing balance. Oops, balance. Okay, now some of them, there's just a statement and not a formula. For instance, for total inflows, you're just going to write add all inflows.
Yeah.
Total outflows, add all outputs. For net cash flow, you write the formula. For opening balance, previous month's closing balance. Then you write the form. So write this down on your sheet in your notebook, all
Okay.
of this, and let me know once you're done. Amazing. Okay. Now, advantages. This before I go over the advantages, they're very basic, generic. Advantages would be, streamline, guide through, manage your finance, blah blah. But what's more important than the advantages, disadvantages? Because you can go over them yourself. They're simple facts. But what's more important is interpreting your data. Okay, that's way more important. Okay, because commenting on it, for instance, you might get a 9 marker on commenting um or improving cash flow for a particular business in paper 2. Okay, so let me give you some ideas that you can use in your exam. So we could say these are your strategies to improve cash flow. Number 1, how can you solve your cash flow problems? What you can do is, now either of these, your case study will always be hinting you towards one of the suitable and best strategy. What students tend to do is they try to throw in a random strategy. They might get a C grade for that, but a student who deserves an A grade must know which is the strategy that the case study is hinting you towards. Okay, the case study is always pushing you towards a one specific answer. Now, one strategy you can do to improve your cash flow is that you can reduce the credit period offered to your customers. Okay, so credit is when you are giving your customers a product but letting them pay later. Okay, so if you are letting your customer pay buy in Jan, you are allowing them to pay in Feb. This can never work in a retail business, but it's usually when you are B2B, business to business, when you're a supplier yourself. Make sense? Yeah.
No, repeat that.
Okay, when you're a supplier, let's say I am a computer manufacturing business and I am selling computers to other businesses so that they can go and sell it in their shops. That means I'm a supplier, right? No? Are you there?
Okay. Yeah, I'm there.
Okay, tell me, who is the supplier? What's a supplier?
A supplier is one who provides the products and services.
Okay, give me a business example of a
Uh,
supplier.
a business supply example of the supplier.
Mm-hmm.
Uh, um, I don't know a business that's a supplier.
You can literally give me any random example, any business that's supplying to another
Oh,
business. Give me a product.
that supplies to another business? I don't know. That supplies to the consumers? Yeah, I do know, but I guess
How
McDonald's?
does the product get to the final consumer? It gets through a business, right? How does that
Yeah,
business get the products?
through other people.
Through other people. Those other people are called suppliers.
Okay. So I'll say Zara.
Okay, Zara, right? And Zara gets their uh, raw material for the production from, let's say, they get their cotton to produce their cotton shirts from a cotton supplier, right?
Yes.
Right? That
Yes.
supplier gives lots and lots of cotton to Zara so that they can produce in their factory. Fair enough?
Yes.
So this is Zara factory and this is their supplier. This is A1 cotton shop. Okay? They give 1,000 meters of cotton to Zara worth $1,000 in the month of Feb. Zara takes it, but they're giving, they said, okay, we'll take it worth this much money. We'll take the material in Feb, but we will pay you in March. We'll pay 1 month later. Does that make sense?
Yes.
This is called a credit period.
Okay, got it.
This is giving someone something on credit. Okay?
Understood.
Now it makes sense, yeah? This is what it is. How can you improve your cash flow? Reduce the credit period so that people can pay you on the spot or within a week or within a few days so that the money comes in to you quicker, faster. Does that make sense?
Yes.
So, by reducing the credit period offered to customers, you can collect the money owed from customers a lot more quicker, which will increase your current assets and your cash inflows. Okay? Right?
Yeah.
So, this will logically increase your inflows, but there can be a catch. Maybe they'll be like, listen, if you're not giving me a credit period or such a short period, I'll go to someone else. So they might leave and choose a competition that's offering a longer credit period. Why should I pay this guy when somebody else is willing to give it to me for a longer credit period. Businesses do that on purpose because they don't want to input money from their own pocket. They want to borrow, they want to sell once the profit is there. Once you get the money, put the profit in your pocket and give the money to supplier. You don't even need money to start a business. So one way to improve your cash flow is to reduce your credit period. Okay. Everything has its own advantages and disadvantages. Okay.
Yeah, okay.
Alternatively, you can ask, because every business has its own supplier as well. So you could ask your supplier for a longer credit period. So that now this is reverse. Now you're asking for an extension from your supplier. You're like, listen, can I take the material in Feb and I can pay you in March? This will mean that your payment is delayed and you got your material basically for free and your outflow for this particular month is reduced. You can pay later. It's like buy now, pay later. Make sense?
Makes sense.
Then comes, now this is another strategy you can suggest. So, but then it has its own advantages, disadvantages. Your supplier might not be happy with you, so it might ruin relationships. Okay. Now, another could be take a short-term source of finance. Remember, we studied short-term and long-term sources of finance? In the last class, which was last week, basically. Short-term, long-term sources of finance. No, yes. Are you there?
I'm here, I'm here.
I think yeah. Do you remember sources of finance?
Uh,
Open your notes from the last class.
yeah.
Look at them and then you'll remember.
Yeah, I remember crowdfunding. It was one.
That was not
And
a
the
short-term source of finance.
short term. Okay, wait, let me get the short term out 1 second. No, wait, we made notes on internal. Okay, yeah, short term, sorry. We said no, wait. Wait. Sorry, 1 second. Like delayed payment, would it be short term?
That's not a source of finance.
But for sources of finance, we only have internal and external. We don't have short term and long term.
But I did explain to you every single thing, which ones are short, which ones are long. Oh, look, either you didn't make the notes properly. I can, Saleha, we need to start studying. Your exam is not too far.
Yeah.
Okay, look, have a look at this. Short term, long term, okay? We talked about bank overdrafts
Sorry, can you point where you are?
right here. Look, bank overdrafts,
Yeah, yeah, I got
instantly
it.
available.
Instant.
We
Okay,
were
yeah.
talking about short term. We were talking about long term. I explained all of this to you.
Yeah. I just need to re watch the recording once again.
Okay. So to improve your short-term source of finance, you can simply just take a and bank overdraft, and that will increase your inflow. Okay. Um, that is another way of improving your cash flow. Another way of increasing your cash flow is sell off excess stock, any spare inventory. Another way you can improve your cash flow is sell assets you don't use.
Yeah.
Okay. All of this is going to bring in money to your business. Okay. So these are the things you
But
can
also
use
I have a
to,
question. But would one also be like decreasing, like, decreasing wages to get more money?
that would just reduce your expenses. It's not bringing any money in the business.
Yeah, true. Okay.
Okay, so I'm sending you the notes. Please start
Yeah.
studying. The exam isn't too far now.
Yeah.
Okay, I'm sending the notes. Go over this. Please make sure you go over the advantages and disadvantages of cash flows.
Yes.
They're pretty simple, listed down in your book. It won't be a challenge to go over them. If there's anything you don't understand, you can ask me.
Sure.
Okay.